Tesla versus Ford. Which one is better? Tesla and Ford both have big plans for electric vehicles, but they're quite different enterprises. Which company is better for which kind of investor? Some people will prefer Tesla's attributes, while others will prefer Ford's. Hello and welcome back to TechSphere, guys. In today's video, we are going to tell you about the major features that differentiate the two famous Tesla and Ford. But before we begin, don't forget to subscribe to our channel. Sandy Munro, together with Cory Steuben, suspension specialist and president of Munro Associates, brutally honest veterans who tell things as they are, examine the Ford Mustang Mach-E suspension and high-voltage wiring in the latest episode of Munro Live. To add to the intrigue, the team compares Ford's ideas to the Tesla Model Y, as well as the Volkswagen ID.4 to some extent. The first point to mention is that the Mach-E's rear suspension, which is excellent in terms of both cost and performance. The only flaw is that one of the links isn't straight to not collide with other parts. In the front, we can see a standard solution that is economical, has a nice turning radius, and provides good driving stability. Whereas Tesla chose a higher level option that is commonly found in premium German vehicles. Munro Live's Cory Steuben points out that the high voltage wiring isn't even near to the level of finesse found in Tesla's exquisite in-house solution. In the case of Tesla, the quality, weight, length, and even operator friendliness installation are all significantly better. The main reason for this is that Ford employs some off-the-shelf components and drive units from outside sources. Sandy Munro wondered at one point if some of the components shouldn't be shared with a Volkswagen, given that the two companies collaborated on EVs, but that was probably due to a lack of research on the news. Let's not forget that Ford and Volkswagen are working together on MEB-based electric cars for Europe. One type has been confirmed and the second is being considered. A rumor from May said that the decision is near. The Ford Mustang Mach-E has nothing to do with Volkswagen because it was developed much earlier, and we have no idea whether Ford will employ the MEB platform outside of Europe. Munro recently went on a drive on the Ford's upcoming Blue Cruise with Ford Driver Assistant Technology Chief Engineer Chris Billman, and the teardown expert and former Ford engineer immediately noted a number of unusual behaviors from the hands-free technology. While Munro admired some of the Blue Cruise's actions, he quickly realized that Ford's advanced driver assistance system couldn't take the off-ramp on its own. This set it apart from Munro's Tesla Model 3 autopilot, which he'd been using for quite some time. That, however, is only the top of the iceberg. Munro quickly discovered that traversing curves using Blue Cruise necessitated physical intervention. When this happened, there was no prominent audible warning to remind drivers to keep their hands on the wheel. Basic moves like lane changes require manual intervention with Blue Cruise, and Billman was unsure if Ford intended to expand the system's driver assistant functions to inner-city streets like Tesla's FSD Beta. Munro came to the conclusion at the end of the trip that the Ford Blue Cruise, at least in its current form, has a lot of potential for improvement. Ford must repair Blue Cruise's inability to manage highway curves, especially those described as sharp turns, according to the disassembly expert. Munro also mentioned that Ford has to enhance Blue Cruise's disengagements, which the driver may find confusing. In 2020, electric vehicle stocks have gotten a lot of attention, causing stocks like Tesla or TSLA to move to new all-time highs. However, stocks like Ford or F have gained traction in 2021 as more and more traditional auto companies have stated their willingness to grow in the EV industry. In this video, we'll compare Tesla and Ford, two very different companies who both want to profit from the EV market's expansion. Let's have a look at Tesla's performance for a better understanding. Tesla is the world's most well-known and largest electric vehicle pure play, so it's no surprise that its stock profited greatly as investors became more interested in EV equities during the pandemic. The stock has risen 360% in the last year, with the company's market capitalization increasing by hundreds of billions of dollars as new investors rushed into the stock. However, in 2021, things have paused, with shares down 1% so far this year at the time of writing. Tesla is currently trading roughly 20% behind its all-time high, which was set earlier this year before Tesla and other growth companies began what appears to be a consolidation trend. Tesla has been a tremendously profitable investment for long-term investors who did not buy the stock at the highs, giving returns of hundreds or even thousands of percentage points to date. As far as Ford is concerned, it is the epitome of a legacy auto firm, which was created more than a century ago. It is one of the industry's top participants, with annual sales of over $150 billion. However, the company has not had much development in recent years, which is why its stock has underperformed. However, investors have gotten a substantial dividend in most years. Ford stock has barely increased marginally in recent years. Ford stock, on the other hand, has increased by about 40% so far in 2021. Many other legacy car businesses such as Volkswagen and General Motors have had comparable good performances in 2021, with 60% and 40% gains respectively. The explanation for this good performance is most likely the investors began to flock to the low-cost stocks of traditional automakers as these businesses unveiled increasingly ambitious EV plans. In comparison to pure plays like Tesla and NIO, which had already seen a tremendous run in 2020, Ford, Volkswagen, and Co. were considered as less expensive, more competitively priced EV investments. There are certain similarities and contrasts between Tesla Inc. and Ford Motor Company that we should be aware of. First, because both are essentially selling to the worldwide vehicle industry, there are numerous parallels to be considered. Automobile markets are notoriously cyclical, which will have influence on both companies in the long run. Furthermore, automotive production is a capital-intensive, low-margin sector, which explains why neither company generates very strong returns on capital or particularly attractive profit margins. With the exception of extreme luxury manufacturers such as Ferrari, this is also true for the majority of their peers. The intense competitive pressures that most manufacturers face, whether they produce EVs, ICE-powered cars, or both, are likely to explain the automotive industry's low margins. Outliers like Ferrari, which sells to price-insensitive customers, are able to produce significantly greater margins and returns on capital. Despite the fact that they both sell cars, there are some significant differences to consider. Tesla's strategy is simple: solely electric vehicles. This is advantageous for the company's growth trajectory, as it sells to a rapidly growing market group. Despite losing market share in the electric vehicle category, Tesla's overall sales have increased at a rapid rate in recent years. Ford, on the other hand, continues to rely heavily on ICE-powered vehicle sales. Although the corporation has lofty aspirations for its young EV sector, ICE-powered automobiles still account for the majority of the company's revenues and profits. Ford wants to release a variety of electric vehicles in the next few years, with the objective of having a 100% electric fleet for its European operation by 2030. Over the last year, the company has become much more active with its EV aspirations, which is likely one of the reasons why its stock has soared in 2021. The company is becoming recognized as a credible EV player. Nonetheless, it cannot be compared to a pure-play EV company like Tesla. There are a few distinctions to consider. Tesla owns a solar and energy storage business that is not profitable but is growing in revenue, and Tesla is looking to expand the aspect of its business to become an integrated energy firm in the future. Ford does not have such aspirations, but it does possess a major banking operation that makes significant profits by providing loans to its clients. Both businesses want to be important players in the autonomous vehicle technology, but their strategies are very different. Ford has teamed up with Argo AI, one of the most well-known names in the AV industry, while Tesla is going it alone with their FSD product, which is currently only at level 2. Both firms envision AV technology becoming a bigger part of their business in the future, with Tesla making big ambitions for a huge fleet of self-driving taxis. This hasn't happened yet, but if Elon Musk's ambitions come to fulfillment, it might become a key profit driver in the future. Ford and Tesla are two extremely distinct vehicle manufacturers that appeal to very different types of investors. Ford appears to be a suitable option for value-oriented investors looking for shares of a low-cost firm with the potential for high dividend payments, in case those get reinstated to pre-crisis levels. Tesla, on the other hand, is more relevant for individuals who desire a piece of a very ambitious firm with big ambitions for the future. And Tesla's investors will almost always ignore valuation in favor of believing that the company's growth plans would eventually justify its current price. Individual performance for value and income versus growth at any cost is a personal choice. Of course, based on one's performance, one can choose to invest in none or both. Ford's revenue and earnings aren't growing much, but its stock is trading at a low price. Tesla is the polar opposite. Its firm is rapidly expanding and its stock is extremely valuable. Despite significant gains in 2021, Ford, the lower growth choice, is still trading at a relatively low valuation. The stock is currently valued at 9.5 times this year's earnings, which is a 15% discount to its historical value. So what is your take on this matter? Tell us in the comments. If you want to see our upcoming videos, subscribe to our channel, ring the bell icon, and don't forget to like our video as well. That's all from my side. Thanks for watching.